So we're going to take a look at the newspaper and chocolate bar business here. We got Bert who's buying 100 newspapers wholesale at $1 each, and he sells them retails for $3 each. Ernie, on the other hand, is in the chocolate bar business. He buys them at $4 each wholesale and retails for $5. We're not going to consider the time that they spend selling these things. So let's take a look at how an accountant would view this. In the case of Bert, well, his revenue is going to be $300 because he sells 100 newspapers at $3 each. His cost of goods sold, again excluding his time, or rather ignoring it, so his profit is going to be $200. Ernie, on the other hand, his chocolate bar is going to cost him $600. That's his cost of goods. He sells them $5 each. So that means 150 times 5. You can check the math. It turns out his revenue is $750, so his profit is going to be $150. An economist doesn't look at it quite the same way, however. Let's take a look at it from an economist perspective. We've got Bert, who has an accounting profit of $200, but he's sacrificing the $150 he could have been making in the chocolate bar business. So, as a result, he's making an economic profit of $50. Ernie, on the other hand, could have been in the newspaper business. He's not. His accounting profit is $150, but he could have been making $200 if he were in the newspaper business. So in effect, he's sacrificing $50. From an economist's perspective, the fact that you're not doing something else, looking at the other side of the fence, is a loss because you could have been doing it. So this is why we take into account the opportunity cost in calculating the economic profit. So let's see what happens with this in the short run. We've got the situation for the accounting profit, $200 and $150, as calculated before. Economic profit resumed in this table. Well, it's likely that Ernie is not going to be in the chocolate bar business for long. He's going to look over at the newspaper at Bert and he's going to say, I can do that. So what's going to happen? Well, when Ernie leaves the chocolate bar market, the supply of chocolate bars is going to shift left, and the retail price of chocolate bars will go down. Then he's going to go into the newspaper business, and the newspaper market's going to... Well, let's take a look at this in terms of graphs. We've got the chocolate bar market on the right, we've got the newspaper market on the left, and as Ernie leaves the chocolate bar business, supply curve shifts to the left, the price of chocolate bars is going to go up. For the sake of argument, let's say it goes from $4 to $5.20, just making up numbers here. At the same time, Ernie's going to get into the newspaper business. So when he enters the supply curve will shift to the right, and there's going to be a new retail price of, let's say, $3 to $2.80, again, just making up numbers. This will carry on until, and there's not going to be just one Ernie, there's going to be several of them, this will carry on until the economic profit is equal to zero, meaning to say that the accounting profit will be the same in both markets or both industries. There's no advantage in shifting from one market to another. In the long run, we expect that the economic profit will be equal to zero, whatever business you're in, whether it's newspapers, chocolate bars. The accounting profit, on the other hand, could be $180. Now, you might ask, well, why work for nothing if you're not going to make any profit? But again, let's be clear about what this means, is that if, for example, you choose not to work at all, well, then you'd be sacrificing the accounting profit of $180. So, in effect, from that standpoint, an economist would say, well, at present, your economic profit is minus $180 because you could be in the chocolate bar newspaper business. This also assumes that all firms are identical, that they all have access to the same technology, and in effect, Ernie can sell newspapers just as easily as Bert. As a first approximation, given the fact that there are 7 billion people in the world, it's not bad. Most of the technology is available, but let's want to carry on with this simple idea here to clarify this, is that it was sometimes referred to as a constant cost industry, or what we'll look at later as perfect competition, is that all firms have identical cost curves, so that means they all have the same technology, same skills. And furthermore, the cost curves don't change as the industry expands or contracts. Now, these are two kind of critical, reasonable assumptions. that, for example, when Bert switches over to the newspaper business, it has no effect on the cost of supplying newspapers, for example. We'll relax this a little bit, specifically the question of special skills or technology. Let's see what this might result in. Let's say, for example, we get a new guy. Big Bird gets into this business. Let's say offhand that Big Bird happens to have long legs. So as a result, Big Bird can deliver newspapers more quickly. In that case, we look at it. Bert and Ernie, well, as before, whether they're in newspapers or chocolate, they'll be making an accounting profit of $180. They'll have an economic profit of zero because if they switch to something else, it's going to be the same as what they've currently got. Big Bird, on the other hand, at least in the newspaper business, is able to deliver newspapers more quickly and will have an accounting profit of $220 and an economic profit of $40. Notice that in this case, if Big Bird were to work into the chocolate bar business, he'd be making, well, the same as the others, $180. So in effect, he'd be sacrificing his economic profit of $40, which he'd get in the newspaper business. Notice too that Bert and Ernie can't have this $40. So it's not as if they're sacrificing Big Bird. They don't have the long legs, so they can't deliver the newspapers quickly like Big Bird. We refer to this $40 that Big Bird is making as an economic rent. It's permanent. It's sometimes referred to as producer surplus. It doesn't get dissipated, at least through normal competition, because nobody can get into the call it cannot imitate Big Bird and be like. Of course, people might try to it, and this sometimes goes by the name of rent seeking, efforts to try to obtain Big Bird's special status or economic profit or rent. Sometimes the $40 can also be construed to be compensation, in effect, for Big Bird's long legs. And that's not an incorrect way of looking at it. It's just another input that's required to be able to perform what he's performing. Again, we'll look at this question later.